But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, or but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'll be 25,000. One day you're going to look back at $50 silver and say, gee, that was really cheap. And with silver, I mean, it's going to blow through $50. And maybe it'll be support for a while before, it's really like a launch pad. And the prices go much higher.
The dollar's purchasing power decline has become a pressing concern for economists and investors, especially in recent years as inflationary pressures have surged. Over the past century, the US dollar has significantly eroded in value, a trend accelerated by the Federal Reserve's practices of monetary expansion and low interest rates aimed at supporting government spending and mitigating economic slowdowns. Once regarded as a symbol of financial stability, the dollar is increasingly scrutinized as central banks worldwide seek alternatives, diversifying into other currencies and tangible assets like gold and silver. Gold has recently achieved record highs, with many experts, including Peter Schiff, suggesting that this could be the onset of a substantial upward trend. As the value of the dollar declines, the real purchasing power of fiat currencies diminishes, driving up the value of physical assets such as gold and silver. A recent analysis by Bank of America underscores this shift, noting that gold has been the top-performing asset of 2024, with prices climbing above $2,500 per ounce, a 20% increase in the year's first half alone. Silver, which has yet to peak, is anticipated to surpass $50 per ounce soon. While looking at historical gold prices, Peter Schiff notes that in 1913, before the Federal Reserve, $20 could buy an ounce of gold. Today, that ounce costs about $2,500, reflecting a 99% decline in the dollar's value. This devaluation accelerated with the Fed's policies, which began after its creation in 1913, shifting the dollar from stability to a steep decline. Looking ahead, Peter suggests that the situation could worsen significantly. Projections indicate that if current inflationary trends continue, the dollar could lose an additional 90% of its value over the next decade. In such a scenario, gold's price could soar to $25,000 per ounce or higher as investors seek refuge in gold amid further currency devaluation. Before exploring this topic in depth, please subscribe to our channel, hit the bell icon, and share this video with anyone who might benefit.
I think that people might get scared out of the market. The biggest days in gold and silver are generally on the downside, but they're just one day. The trend is up. Gold just hit an all-time record high. We're nowhere near the top of this cycle. Gold prices, I think, are going to move up multiples of where they are right now, many multiples. So we're still very close to the low end of where gold's going to be trading in the not too distant future. Silver hasn't even taken out a high yet. I mean, silver's still under $30 an ounce. It double topped at $50 an ounce in 1980 and in 2020. One day you're going to look back at $50 silver and say, gee, that was really cheap. And with silver, I mean, it's going to blow through $50. And maybe it'll be support for a while before, it's really like a launch pad. And the prices go much higher. But it's not so much silver getting more expensive. It's fiat currencies losing value. When the Federal Reserve was first created in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. The dollar has lost more than 99% of its value ever since we turned it over to the Fed. But if you go back to when the Republic was started in 1789, when we ratified the Constitution, you needed $20 to buy an ounce of gold in 1789. And in 1913, it still was $20 to buy an ounce of gold. So our money had stable value. In fact, it increased in value. Prices were half in 1900 what they were in 1800. So when we didn't have a Federal Reserve, when we had sound money, when we had gold and silver as money, prices went down and the dollar maintained its value, actually became more valuable. But ever since we turned it over to a central bank, the dollar's been destroyed. But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'll be 25,000. And that's just 90%, not 99%. That then you'd have to add another zero, 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings. It's a way to protect your purchasing power. It's better than keeping your money in cash. Even if that cash pays a small amount of interest, it's still not enough to offset the inflation. So it's still a negative interest rate. And so a zero interest rate on gold is better than a negative interest rate on cash. And sometimes if you think that assets are too expensive, if the stock market is high, if real estate is overpriced, and you want to have dry powder, it's much better to keep your dry powder in gold and silver than in a fiat currency. Because it's possible that when you need the dry powder, your fiat currency is going to be all wet because inflation is going to destroy it. I mean, even if asset prices come down, they may not come down in terms of dollars or euros, but they really could come down a lot in terms of gold, which is what I expect. I expect ultimately we're going to have deflation. The government is doing everything it can to prevent assets from deflating, but it won't work. Prices will deflate, just not in their fiat currencies. They can control that. They can make sure that prices always go up in the currency that they create, because that currency has no real value and they can create as much of it as they want. But what they can't prevent is prices from collapsing in terms of real money that they can't create, which would be gold and silver. And so that's what people should be holding if you are hoping to take advantage of a bargain, of a fire sale on assets, and you want to have the ability to buy them. The money you should be saving is gold and silver.
The Bank of Japan, BOJ, has pursued a policy of exceptionally low interest rates for nearly a decade, aiming to stimulate economic growth and combat persistent deflation. By keeping rates near or below zero, the BOJ hoped to encourage borrowing, spending, and investment, stimulating economic activity in one of the world's largest economies. However, this approach has faced significant challenges. Recently, the BOJ shifted its strategy in response to rising inflation by increasing interest rates. This move, intended to control inflationary pressures, led to severe market disruptions, including a dramatic 20% drop in the Nikkei index. This sharp decline highlights the precarious balance central banks must maintain. While raising rates is necessary to manage inflation, it can destabilize financial markets. Peter argues that the Bank of Japan's prolonged low interest rates were primarily aimed at manipulating the yen and supporting heavily indebted corporations rather than fostering genuine economic growth. He believes that the BOJ's efforts to generate inflation were misguided, and that stable prices or mild deflation would have been preferable. According to Schiff, the BOJ's focus on maintaining low rates has only obscured deeper economic problems. This lack of a clear solution suggests that significant economic pain is imminent, either through continued erosion of purchasing power or a major financial upheaval driven by unsustainable debt.
It's going to be very difficult for them to lower rates. They still need to raise rates, and they're going to raise rates. They just, they don't know how to do it because you can't do it without disrupting the markets. I mean, they started to raise rates, and the Nikkei collapsed. Between a Friday and a Monday, it was down 20%, and it was the biggest. The Monday in Japan was the biggest decline, and the Bank of Japan panicked on that Wednesday. The market had a rebound on Tuesday, and it was probably going to roll over and make new lows. And then the Bank of Japan came out and said, hey, we're not going to hike rates anymore if the markets are destabilized. And then everybody bought stocks, and everything is great because the Bank of Japan basically said we're not going to raise rates because there's no way to raise rates without destabilizing the markets. But if they don't raise rates, the inflation problem in Japan is going to get worse and worse and worse. And so eventually they're going to have to do it. The question is, how much longer can they hold out? But, for years and years, the Japanese created inflation under the pretense that they didn't have enough inflation. Well, that was a lie. There's nothing wrong with low inflation. In fact, deflation, prices going down is actually better than prices going up slightly. But they bought into this nonsense that inflation should be 2%, and that if it's 0.5%, then there's a problem that the central bank needs to solve. Well, that is absolutely ridiculous. You don't have to solve that problem. Prices going up 0.5% per year are better than prices going up by 2% a year. So there's nothing to worry about, right? It's like nonsense. Nobody wants the cost of living to go up. Everybody wants prices low. And if prices go down, that's better than prices going up. So it's all nonsense that economies do better when prices are rising. They do better when prices are falling. And strong economies cause prices to fall because they produce more stuff. More supply means lower prices. So the government was fighting a fictitious battle. The real reason the Bank of Japan kept interest rates low was to suppress the yen and to prop up the government in Japan and to prop up companies that had taken on too much debt that might have gone under. Companies going bankrupt that need to go bankrupt, it's better than having zombie companies continue indefinitely, propped up by the government. And forcing the Japanese government to cut spending is better than subsidizing massive debt. Now, if you look at the Japanese debt to GDP, it's enormous, 225, 250%. And one of the main reasons the Bank of Japan can't raise interest rates is because the government of Japan can't afford it. The only way the government of Japan would be able to afford to pay those rates would have to be to raise everybody's taxes to get the extra income, but they don't want to do that. So instead, we're going to raise everybody's prices by creating inflation. But Japan is in the same box that the Fed is in, that the European Central Bank is in, that the Bank of England is in. All of these central bankers made the same mistakes. They all kept interest rates too low. They all subsidized their governments to go deeper into debt by doing their own version of quantitative easing, asset purchases. So now all these countries are loaded up with debt, not just on a public level, but on a corporate level, on an individual level, and everything is going to collapse.
As inflation continues to erode the real value of cash, holding onto cash becomes increasingly risky. Despite modest interest rates, cash deposits often fail to keep up with rising prices, resulting in negative real returns. In contrast, gold and silver are seen as more reliable for preserving wealth in uncertain economic times. Analysts, including Peter Schiff, anticipate these metals will maintain or even enhance their purchasing power, offering a safeguard against the decline of fiat currencies. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.